Good morning. Welcome to another episode of the Mizuho Week Ahead. I'm Boon Heng, market economist at Mizuho Bank. This week's theme is policy, surprises and expectations. Clearly, risk sentiments last week has been bolstered by the larger than expected rate cut of 50 basis points by the Fed as the S&P 500 hit record highs. USD bulls, though, were not as fortunate as 2-year yields remained buoyed. This was on account of the dot plot, which was hardly more dovish across the policy trajectory over the next 2 years. Accordingly, the dollar has also retained traction, with the DXY above mid-100 to end the week. Across the Atlantic, the BOE held rates as expected and maintained their current pace of quantitative tightening, which boosted the pound and great yields as well. In Japan, the BOJ stood pat on policy, but dovish Governor Ueda stated diminished upside inflation risk, which allows the BOJ time to consider policy options. And he also highlighted the need to observe the impact of earlier hikes. In turn, the dollar-yen rose above 143 as yen led losses last week. In EM Asia, Bank Indonesia, in a surprise move, cut policy rates by 25 basis points as Governor Wajio took a pro-growth angle. Undeniably, this move has been enabled by the recent rupiah appreciation, and further easing also continues to rest on stable and appreciating rupiah, low inflation, and the need to drive higher economic growth. While Bank Indonesia has highlighted global monetary policy uncertainty, the easing bias is retained, given that there are monitoring opportunities to lower the policy rate. Even on a non-rate setting week in the Philippines, the BSP has moved to cut the reserve requirement ratio by 250 basis points to lower intermediation costs and promote better pricing for financial services. These moves are reflective of the less threatening greenback, which reduced the associated risk of the liquidity injection. Meanwhile, in Taiwan, the CBC kept rates unchanged. Amid rising housing prices and housing loans, they raised their reserve requirement ratio and tightened various credit measures to stem the ascending real estate lending to total lending ratio, which is approaching record highs and fueling concentration risk concerns. These measures are largely aimed at tackling speculative property investments rather than owner-occupied loans and first home owners. For the upcoming week, the RBA is expected to buck the trend of major peers as they stand pat on 24th of September. Down under, inflation's decline in July is merely the effect of a drop in electricity costs driven by the cost of living measures by the government rather than a signal that underlying price pressures have abated. Furthermore, resilient labor market gains amid very robust employment also allow the RBA to focus on the inflation side of the dual mandate rather than being focused on both. On that note, while the headline CPI, which is released on Wednesday, will likely decline on petrol prices to slow Aussie rallies, but yet it provides little real comfort for Aussie bears, given that the policy inclination is to stand pat for 2024. All in, attention remains firmly on growth in the US as risk assets look to the revised US GDP print to affirm the soft landing narrative, which will likely be amplified by Fed figures throughout this week. For more information on the key central bank events this week and data releases, please refer to our Week Ahead publication or contact your respective sales desk and RMs. And for regular notifications on our market views, please subscribe to our channel and hit the notification button. Thank you.